It's August 2012. Europe is on fire financially speaking. Spain's borrowing costs have surged to levels that economists call unsustainable. Greece has already imploded once. Italy is teetering. Markets are in a death spiral. And elected governments across the continent are powerless to stop it. And then one man, unelected, unaccountable, barely known outside of financial circles, walks to a podium at an investment conference in London. He speaks for about 11 minutes. And just like that, the crisis is over. Not because of a new law, not because of a democratic vote, not because armies mobilized or governments reformed overnight. It ended because Mario Draghi, the president of the European Central Bank, said 6 words that would go down in financial history. Whatever it takes. Bond yields collapsed. Stock markets surged. Billions of dollars moved, not because anything had actually changed in the real economy, but because one man's words shifted the expectations of every investor on Earth. Think about that. For a moment, no vote was held. No parliament approved it. No citizen was consulted. The fate of 340 million Europeans pivoted on a sentence uttered by someone most of them had never heard of. So here's the question I want you to sit with for the next 20 minutes. Who actually runs the world's economy? And did you ever get a say in it? Because the answer, once you see it, cannot be unseen. Before we go deeper, let's establish something most people get wrong. When most people think about who controls money, they think of governments, presidents, finance ministers, the people they vote for. But here's the thing. In most of the world's major economies, the institution that actually creates money sets the price of borrowing and backstops the entire financial system is not the government, it's the central bank. And central banks are deliberately strict, and in many cases, legally designed to be insulated from democratic pressure. Let's define the machinery. We're talking about a central bank is an institution that performs 3 core functions. First, it issues and controls the nation's money supply. Second, it sets the benchmark interest rate, which cascades through every mortgage, every business loan, every credit card in the country. And third, it acts as the lender of last resort, the emergency backstop when the financial system starts to crack. The United States has the Federal Reserve. The Eurozone has the European Central Bank. The United Kingdom has the Bank of England. Japan has the Bank of Japan. And above all of them, acting as a kind of central bank for central banks, sits the Bank for International Settlements in Basel, Switzerland, an institution so obscure that most people have never heard its name, despite the fact that it hosts the meetings where the world's most powerful monetary policymakers coordinate in private. That's the stage. Now let's talk about how it was built and why it was built the way it was. It's 1910. A private railway car, its windows blacked out, departs from Hoboken, New Jersey under cover of darkness. Inside, 7 of the most powerful bankers and financiers in America. Their destination is a remote hunting retreat called Jekyll Island, off the coast of Georgia. Their mission is classified. They travel under aliases. What they produce over the next 9 days will reshape the United States and eventually the world more profoundly than almost any act of Congress in history. They are designing the Federal Reserve. The men in that car included representatives of the Rockefeller banking interests, J.P. Morgan's allies, and a senior official from the U.S. Treasury. Their goal was not nefarious in a cartoon villain, since they genuinely believed the U.S. financial system was dangerously unstable, and they were right. The panic of 1907 had nearly collapsed the economy, and only a last-minute bailout personally organized by J.P. Morgan had prevented full catastrophe, but the solution they designed reflected their interests as much as the public's. They wanted a system that could print money and expand credit, but one that would be protected from populist politicians who might devalue currency to win votes or cancel debts. The result was a central bank designed with the appearance of public accountability and the reality of private insulation. The Federal Reserve Act passed in 1913. Its founding architecture gave the Fed just enough government oversight to pass constitutional muster, while embedding just enough distance from elected officials to protect it from political pressure. The key phrase was independent within government. That phrase, independent within government, is arguably the most consequential. piece of political engineering in modern economic history. Because it meant, yes, technically part of the state, but no, not answerable to the people the state serves. And once the United States adopted this model, the rest of the world followed. Britain's Bank of England, founded in 1694, was nationalized in 1946, but only given true operational independence in 1997, a decision made not by voters, but by a chancellor of the exchange. Announced with almost no public debate, the European Central Bank, created in 1998, was specifically designed with an independence mandate written into the treaty, meaning even if every elected government in Europe wanted to change its mandate, they couldn't without renegotiating a multi-nation treaty. Central bank independence wasn't an accident. It was a deliberate design choice made by policymakers who distrusted democracy's relationship with money. And for a long time, that logic seemed reasonable for most of the 20th century. Central banks operated in relative obscurity. They raised and lowered interest rates, tamed inflation, managed crises. They were important, but largely boring. The plumbing of the economic house, not the architecture. Then came Paul Volcker, appointed as Federal Reserve Chairman 1979 by Jimmy Carter. Volcker faced an economy ravaged by stagflation, the toxic combination of high inflation and stagnant growth that economists had previously believed was impossible. His solution was brutal and brilliant in equal measure. He jacked interest rates to 20%. To put that in context, today, if mortgage rates hit 8%, it triggers a housing crisis. Volcker pushed rates to 20. The U.S. economy went into a severe recession. Farmers drove tractors to Washington and blockaded the Federal Reserve Building. Construction workers mailed wooden 2x4s to the Fed with notes reading, "We can't afford to build houses. Maybe you can use this." But it worked. Inflation broke. And when it did, Volcker became a legend. The lesson the world drew from Volcker was this: central bank independence works. A courageous technocrat can make the hard decisions that spineless politicians won't. From that point on, central bank credibility became the gold standard of economic governance. The 1990s and 2000s saw an explosion of central bank independence globally. The IMF practically required it as a condition of loans. Academic economists produced paper after paper showing that independent central banks produced lower inflation and more stable growth, and the stature of central bankers grew accordingly. Alan Greenspan, who succeeded Volcker, became known as the Maestro. Senator Daniel Patrick Moynihan joked that Greenspan's briefcase was watched like a Vatican chimney if it was thicker. The economy was in trouble. Markets hung on his every syllable, analyzing the precise construction of his sentences for hidden signals. By the early 2000s, the Federal Reserve Chairman had arguably more daily influence over the American economy than the President of the United States, and no one had voted for him. This is the paradox that sits at the heart of our story. Central bank independence was designed to protect monetary policy from short-term political pressures. But somewhere along the way, it evolved into something broader, a permanent, insulated governing authority with power over the economic conditions of billions of lives, accountable to no electorate, subject to no direct democratic override. September 15, 2008, Lehman Brothers files for bankruptcy. The global financial system freezes. Credit markets lock up. For a brief, terrifying window, ATMs in parts of Europe are close to running out of cash. And what saves the world, not Congress, it initially rejected the first bailout bill, not the president. George W. Bush's approval ratings were in the 20s. His political capital was essentially zero. What saves the world, or at least prevents total collapse, is the Federal Reserve, acting in a matter of days with tools that had never been used before. Moving trillions of dollars without a single public vote, the Fed cut interest rates to near zero. It launched something called quantitative easing, QE, which is the technical term for creating new money and using it to buy financial assets. It opened emergency credit lines to banks. It extended swap lines to foreign central banks. It became, in effect, the financial government of the world. Here is the data that should make you pause. Before the 2008 crisis, the Federal Reserve held approximately $900 billion in assets. By 2014, that number was $4.5 trillion. By 2022, it had reached $9 trillion. $9 trillion, created by an institution that answers to no voter now. Here's where the story gets complicated, because the QE debate is not simple. There are serious economists who argue QE prevented a second Great Depression. There are equally serious economists who argue it inflated asset bubbles, widened inequality, and created distortions in the economy that we are still paying for today. But here's what's not debatable. The decision was made by central bankers, not by elected governments, and the consequences, whatever you think of them, landed on everyone. Research from institutions including Oxfam and the Federal Reserve itself has shown that quantitative easing disproportionately benefited asset owners, people with stocks, real estate, and financial portfolios. Since wealthy people own the vast majority of those assets, QE functionally transferred wealth upward on a massive scale, even as it was being justified as a measure to help the broader economy. Savers, particularly retirees dependent on interest income, had their returns effectively zeroed out for a decade. None of these distributional consequences were voted on. They were the side effects of technocratic decisions made in closed rooms. Let's talk about what happens when you hold interest. Rates near zero for 14 consecutive years. This is not ancient history. This is the world most millennials and Gen Z have grown up in. And it explains more than almost any other single policy why the economy feels broken to so many people under 40. When borrowing is essentially free, a specific cascade of events occurs. First, corporations borrow not to build factories or hire workers, but to buy back their own stock, inflating share prices and executive compensation without creating a single job. Second, real estate becomes not a place to live, but an investment vehicle. When money earns nothing in the bank, capital flows into property. Home prices in major cities, New York, London, Sydney, Toronto, Frankfurt, have risen so far beyond wage growth that a generation of workers can no longer afford to live in the cities where the jobs are. Speculative assets, from cryptocurrency to SPACs to NFTs, attract floods of capital from investors desperate for any return. Bubbles form, bubbles pop. Regular people who got in late lose their savings. Fourth, companies that never made a profit, and in some cases had no plausible path to profit, received billions in funding simply because investors had nowhere else to put cheap money. The unicorn era of inflated tech valuations was not a story of genius entrepreneurs. It was largely a story of near-zero interest rates. All of this was the downstream consequence of central bank decisions made by committees of economists, not by voters. And then, when inflation finally arrived in 2021 and 2022, fueled by pandemic supply shocks and the enormous money creation of the COVID era, those same central banks slammed the brakes. They raised interest rates at the fastest pace in 40 years. The housing market froze. Mortgages became unaffordable. Small businesses that had borrowed to survive the pandemic suddenly faced crushing debt service costs. Regional banks that had loaded up on long-dated bonds, which lose value when rates rise, started failing. Silicon Valley Bank, Signature Bank, First Republic, gone in a matter of days, and millions of ordinary people who had made entirely rational financial decisions based on the interest rate environment central banks had deliberately created found themselves suddenly holding a bag they never asked. For here is the pattern. Distilled, a crisis happens. Central banks respond with extraordinary measures. Those measures solve the immediate problem while creating new distortions. The distortions build up over years. A new crisis happens often because of the distortions. Central banks respond with even more extraordinary measures. Wash, rinse, repeat. We saw it in 1987. We saw it in 1994. We saw it in 1998 with the long-term capital management collapse. We saw it in 2001. We saw it in 2008. We saw it in 2020. And the distortions from 2020's response are still working their way through the global economy right now. Each cycle, the interventions get larger. The balance sheets get bigger. The tools get more unconventional. And the accountability gap, the distance between the decisions being made and the people who live with the consequences, grows wider. Consider some numbers. From the present day, the combined balance sheets of the G7 central banks, the Fed, the ECB, the Bank of England, the Bank of Japan, the Bank of Canada, and others, exceeded $27 trillion at their peak in 2022. That is larger than the entire GDP of the United States. The Bank of Japan owns more than half of all Japanese government bonds, more than half. It also owns a substantial portion of the Japanese stock market through ETF purchases. Japan's central bank is, in effect, a major owner of the Japanese economy. The European Central Bank's asset purchase programs have been challenged in the German Constitutional Court multiple times because German citizens have gone to court arguing that an unelected institution is making fiscal policy decisions that belong to elected governments. And here is perhaps the most striking modern data point. A 2023 study published by economists at the Peterson Institute found that central bank decisions account for more variation in household economic outcomes, employment, mortgage costs, savings returns, inflation than the fiscal policies of elected governments in 80% of developed economies. 80%. The institution you never voted for shapes your financial life more than the one you did. This raises an obvious question. Why don't we just fix this? Why don't we make central banks more democratic? People have tried. In the United States, the Audit the Fed movement, supported at various times by both Ron Paul on the libertarian right and Bernie Sanders on the progressive left, has repeatedly pushed for greater congressional oversight of Federal Reserve operations. The bill has passed the House multiple times. It has never become law. The opposition argument is always the same. If politicians can audit and direct the Fed, they will use it for short-term electoral gain, printing money before elections, keeping rates artificially low to juice growth, sacrificing long-term stability for short-term popularity. It's a reasonable concern. History has examples that support it. But the counter-argument is just as reasonable. If an institution has the power to reshape the economic lives of every citizen in the country, and that institution is never subject to democratic accountability, then you don't actually have a democracy. You have a technocracy with democratic decoration. This tension has no clean resolution, and that's why the debate never goes anywhere in Europe. Efforts to make the ECB more transparent and accountable have made some modest progress. The institution now holds press conferences, publishes minutes, and appears before the European Parliament. But its core mandate and independence are still constitutionally embedded in the EU treaties. In the UK, the Bank of England holds town hall events and publishes detailed communications, but the governor is still appointed by the Chancellor of the Exchequer, meaning the government of the day effectively chooses who runs monetary policy. Without a public vote, the reforms that have happened are largely about transparency, better communication, clearer explanations. What they have not addressed is the fundamental question of democratic legitimacy. Who gave these institutions the right to make these decisions? The honest answer is, economists gave economists that right, and the rest of us mostly didn't notice until the consequences started landing in our daily lives. So, we've covered a lot of ground. Let me give you 3 clear takeaways, and then leave you with something to think about. Takeaway 1. Central bank independence is a tool, not a truth. The argument for central bank independence is not ideological, it's institutional. The idea is that some decisions require insulation from short-term political pressures to be made correctly. That's legitimate. But insulation from short-term pressure is different from permanent immunity from democratic accountability. We can have one without the other. The question is whether we have the political will to draw that line. Takeaway 2. Central bank decisions are not neutral. They have winners and losers. Every interest rate decision, every bond purchase, every liquidity facility redistributes wealth and opportunity across society. Low rates help borrowers and hurt savers. Key inflates asset prices and benefits the already wealthy. High rates slow inflation, but also slow employment. These are distributional choices. They benefit some groups and disadvantage others. When those choices are made by unelected technocrats with no accountability mechanism, the distributional consequences are invisible to the political process. That is a democratic problem, regardless of your politics. Takeaway 3. The system is more fragile than it looks, precisely because of how much we've asked central banks to do. When central banks become the first, last, and only responder to every financial crisis, Elected governments atrophy. Politicians learn that they don't have to make hard structural reforms because the central bank will always ride to the rescue. This creates a doom loop. Political inaction leads to more crises, which leads to larger central bank interventions, which leads to more distortions, which leads to more crises. Now, the warning, the next major financial disruption, and there will be one. There is always one, will arrive in an environment where central bank tools are significantly depleted. Interest rates, even after the hikes of 2022 and 2023, are still historically low in real terms. Balance sheets are enormous. The unconventional tools that were emergency measures in 2008 are now standard practice. What happens when the next emergency arrives and the central bank has already used its ammunition? That is not a hypothetical question. It is a question that the world's most serious monetary economists are actively debating right now, and the answers they're generating from central bank digital currencies, to negative interest rates, to direct monetary financing of government spending, are more radical, more intrusive into daily life, and further from democratic oversight than anything we've discussed today. The quiet control is becoming less quiet, and the question of who should have that power and how we, as citizens, should participate in that decision is one of the most important political questions of our time. Here's the open thought I'll leave you with. Mario Draghi's 6 words, whatever it takes, saved the Eurozone in 2012. Most economists agree that was the right outcome, but imagine for a moment that the next central banker who steps to a podium with 6 words has a different idea of what whatever it takes should mean. Imagine it means controlling your spending through a programmable digital currency that expires if you don't use it. Imagine it means negative interest rates that slowly drain your savings if you hold too much cash. It means the central bank directly monetizing government debt, funding public programs by creating money, bypassing democratic budgeting entirely. None of these scenarios are science fiction. All of them are being actively discussed by central bankers right now. The question is not whether central banks will have power. The question is whether you will have any say in how they use it. That's not something a YouTube video can answer, but it is something worth demanding an answer to. If this video made you think, if it challenged something you assumed you understood, consider sharing it with someone who thinks the economy just happens the same way weather happens. It doesn't. It's built by institutions with choices made by people. And the first step to having any influence over those choices is understanding who's making them. Drop a comment below with the one thing from this video that surprised you the most. I read every single one. And if you want to go deeper, there's a follow-up video linked in the description that covers what central bank digital currencies could mean for financial privacy. It's one of the most important topics nobody's talking about. See you there.